Securitize hits record 4.3B tokenized AUM, but post 21.7 million loss. Securitize reported second quarter 2026 results on August 12th, its first earnings as a New York Stock Exchange company, and the numbers pulled in two directions at once. Average tokenized assets under management reached a record $4.3 billion, while quarterly revenue fell 5% year-over-year to $14.4 million, and net loss widened to $21.7 million. The figures come from Securitize's own earnings release and its Cointelegraph announcement, published August 13, 2026. The market read the headline loss first. Shares dropped more than 20% after the report, as revenue of $14.4 million missed the $20.6 million analysts had modeled. Record assets. Thinner top line. The tokenization business grew on the metric that matters most to it. Average tokenized AUM rose 16% to $4.3 billion, and quarter-end AUM climbed 9% to the same level, recovering roughly $1 billion after 2 quarters of crypto-driven declines. Aggregate transaction volume jumped 147% to $5.3 billion. More assets on the platform did not translate into more revenue this quarter. Total revenue fell 5% year-over-year, and diluted loss per share widened to 2.37. The gap between rising AUM and slipping revenue points to fee compression, product mix shifting toward lower margin mandates, or both. Securitize administers tokenized products like BlackRock's BUIDL fund, where basis point fees on large, stable balances can grow assets faster than they grow the top line. Costs outran the growth. Adjusted EBITDA swung to a $5.5 million loss as operating expenses climbed. Part of that is the cost of being newly public, compliance, reporting, and headcount that a private company can defer. Part is the spend required to keep winning tokenization mandates in a market where BlackRock, Franklin Templeton, and a wave of banks are all building. The $21.7 million net loss and negative EBITDA are the price Securitize is paying to hold its lead in a category it helped define. Whether that spend converts into durable fee income is the question the 20% share drop is asking. Tokenization keeps scaling around the loss. Securitize's rough quarter lands against a backdrop of accelerating real-world asset activity. Wall Street's tokenized fund pile has crossed several $billion, and infrastructure keeps arriving. The NYSE is building an on-chain settlement platform for tokenized securities, and a 40-firm consortium led by JP Morgan and Goldman is running a shared tokenized asset trial. Demand for the plumbing is real. Turning that demand into profit is the harder part. The distribution picture stays uneven. Roughly $7 billion sits in tokenized funds, yet under 1% of it flows into DeFi, which means most of these assets behave like conventional funds wearing a blockchain wrapper. That limits the composability premium tokenization was supposed to unlock, and it caps how much fee-generating activity a platform like Securitize can layer on top. Reading past the miss 1 week quarter does not settle the tokenization thesis. Record AUM and 147% higher transaction volume show the pipeline is filling, and a first public earnings report almost always carries elevated costs. The signal to watch is the direction of revenue against AUM over the next 2 quarters. If assets keep rising while revenue keeps slipping, the fee model needs a rethink. Not just patience. For crypto users, Securitize sits upstream of the products increasingly used as collateral, yield sources, and settlement assets across the ecosystem. Tokenized treasuries and funds are already appearing in DeFi lending markets, and eventually in the balances behind stablecoin-linked spending. A slower, more expensive quarter at a key issuer is a reminder that the infrastructure layer is still finding its economics, even as adoption climbs.